U.S. first quarter GDP was just downgraded to 1.6%. At the exact same time, April PCE inflation spiked to 3.8%, marking a three-year high. When economic growth slows while consumer prices surge, corporate profit margins are squeezed from both sides. Historically, this mathematical trap forces institutional investors to aggressively sell off equities across the board. We see that happening in the retail sector right now. Lower-tier consumer staples are breaking down. Costco and AutoZone both delivered heavy earnings misses this week, with AutoZone plunging over 11% in a single session as shoppers hit their credit limits. But looking at this dual-axis chart, there is a massive divergence. While AutoZone and Costco collapse, the Dow Jones Industrial Average just broke through the 51,000 ceiling, and the Nasdaq added 628 points in 5 days. Institutional capital is filtering the PCE data through a new lens. Buy orders are flowing into AI hardware, as a bet that automation is the only viable defense against rising labor costs, effectively using technology as a macro hedge against the broader economic decay. The market has split into two completely separate realities. The tech sector's ability to ignore collapsing consumer metrics relies entirely on a specific algorithmic adjustment currently playing out inside the bond market. That adjustment started with a sudden geopolitical intervention. The Biden and Trump administrations successfully brokered a 60-day ceasefire agreement between the U.S. and Iran. The algorithmic reaction was instantaneous. Brent crude prices collapsed from $96 a barrel down to $91. Wall Street trading models immediately ingested that drop in energy costs. They repriced forward inflation expectations, coding the terrifying 3.8% PCE print as a temporary artifact of previous oil supply shocks. This gives the Federal Reserve an excuse to freeze. Newly appointed Fed Chair Kevin Warsh is currently trapped between hawkish board members like Schmid and dovish members like Bowman. With oil dropping, Warsh has the political cover to avoid hiking rates. Looking at the yield curve here, you can see the direct result. The 10-year Treasury yield has relaxed and stabilized perfectly at 4.45%. That 4.45% line is the prerequisite oxygen for the entire market. As long as long-term borrowing costs stay capped at that level, tech companies have the valuation multiples required to keep expanding. Corporations are currently facing severe wage inflation. To offset the rising cost of human labor, they are taking on debt to fund massive AI automation projects, turning hardware infrastructure into a necessary survival mechanism. Micron technology just crossed the $1 trillion market cap threshold, driven by a UBS price target upgrade to $1,625 per share. Memory chips have historically suffered from vicious boom and bust inventory cycles. Micron replaced that model with long-term, locked-in infrastructure contracts, securing highly predictable revenue from hyperscalers. Dell Technologies reported a $513 billion backlog in AI server orders this week. Their true competitive moat lies in liquid cooling infrastructure, enterprise storage, and Dell Financial Services leasing agreements, which lock clients entirely into their hardware ecosystem. Looking at Dell's daily candlestick chart, chasing the immediate 32% gap up carries heavy risk. The institutional entry strategy is to wait for a technical pullback, targeting this $380 to $400 zone just above the 10-day moving average. For risk management, a hard stop is placed at $317, which marks the top of the pre-earnings consolidation phase. Based on Dell's guidance of $60 billion in forward revenue, the upside target sits securely in the $480 to $500 range. Full-stack server companies have transitioned into global utility providers. Their capital moats are now designed by multi-year service agreements and critical cooling infrastructure, detaching them from the traditional hardware cycle. The sheer scale of AI buildouts is exposing new physical limitations, with companies like SpaceX deploying massive 220,000 GPU clusters. Raw compute power is no longer the primary constraint. The system is choking on data transmission. Moving information between chips fast enough to keep the GPUs fed is the new infrastructure bottleneck. Marvell Technology holds an absolute monopoly in custom silicon, or XPU, and the high-speed optical interconnects required to solve this problem. Marvel projects 70. On the upside, quarter-over-quarter revenue expectations of $2.7 billion provide the momentum for a $240 price target. Owning the transmission layer insulates Marvell. Even if hyperscalers pause their GPU purchases to digest inventory, the demand for faster interconnects remains constant. There is a prevailing theory on Wall Street that large language models will rapidly commoditize, ultimately destroying the pricing power of traditional enterprise software companies. Capital flow shows the exact opposite. Investment is rotating out of hardware hoarding and into agentic AI, where corporations actually monetize the models. Salesforce reported that its Agentforce platform is already generating over $1 billion in annual recurring revenue. They are successfully packaging and selling AI as measurable digital employees. Snowflake's recent earnings print confirms this shift. They delivered a 34% jump in product revenue, alongside a massive 126% net revenue retention rate. Snowflake deployed its Cortex Code platform, evolving its core product from a static data warehouse into a highly sticky central operating console for corporate data. Looking at Snowflake's chart, we see a massive 36% upward gap following earnings. Utilizing right-side trading logic, the tactical setup is to buy the retest of this gap's upper boundary, specifically in the $220 to $225 zone. If institutional support cracks and the price drops below the gap's lower edge at 190, the trade is stopped out. If support holds, midterm valuation repair points to a target of $280 to $300. Enterprise software moats are proving resilient. This layer is becoming the final destination for AI capital, where massive hardware investments are finally transformed into high-margin recurring revenue. The market is operating on two entirely separate tracks. Consumer-reliant sectors are collapsing under the weight of real interest rates, while AI infrastructure and enterprise software thrive as mandatory corporate hedges. The primary variable holding this dynamic together is geopolitical. The Trump administration's final execution of the Iran Memorandum of Understanding dictates the immediate future of the energy market. If that ceasefire fails, crude oil will spike. Higher energy costs will instantly shatter the current inflation illusion, forcing the Fed's hand and crushing the tech sector's valuation premium. Beyond the broader indices, specific defense investments from the Office of Strategic Capital require attention, particularly targeted drone infrastructure equities like ONDS. Finally, Fed Chair Warsh's upcoming guidance on quantitative tightening will establish the absolute floor for long-term Treasury yields, determining the cost of capital for the rest of the year. For more deep-dive U.S. stock and market analysis, remember to like, subscribe, and share Calling Monster Finance.